All right, I guess we're live. Well, welcome back. Been a crazy market past couple of days. The things I'm watching are all of the momentum stocks and the debasement trade. And, really when you're looking at the overall market, it's not telling you what's going on. So yesterday was a slaughter for all the, all the hot momentum type names. Also the debasement trade's been taking it on the chin. Gold corrected past couple of days. Crypto's been going down. I think all that stuff is trying to rally back a little today. I wrote about this in my newsletter. Like if you're looking for a top, this is what a top looks like, but it's also a normal kind of movement. When things go too far, too fast, they pull back a little bit, and it's happened a bunch of times this year. It's always been a buying opportunity. Cautiously treating it the same way now, but keep your head on a swivel just in case. So I don't know, Jeremy, you have any thoughts?
Yeah, this market's kind of still following the bull channel on that diamond pattern from way back. Still slowly trending, but it's definitely a time to be cautious. I mean, if you look at the daily chart, that broadening pattern at the top of a bull trend is pretty ominous. Typically, they tend to be a top. So definitely have a word of caution in the back of your mind when you're scalping stuff in this market. Things can happen pretty quickly.
Right. So
be nimble.
Matt, you talked about the Trump trade. It's been great. It's killed all year. The stocks all crashed a little bit yesterday. But Trump said something this morning about quantum, right? Like, I'm going to go invest in quantum. I thought those stocks would be up a ton. I think they're up some, right? But
yeah, I mean, I haven't looked since pre-market. So my favorite is actually a SPAC. It's CCCX.
Repeat that?
What's that?
What's the symbol?
CCCX.
Charlie X-ray?
That is correct.
All right, got it. Okay, good.
Yeah, it's still a pre-merger SPAC. It's a Churchill SPAC. They've got an announced merger with a quantum company. I forget off the top of my head which one it is. But the cool thing about it is you've got a known downside. It's, somewhere in the tens. I don't know exactly what cash and trust is. The last I looked, it was like 13 and change. I mean, it's still at 30% potential downside, but that's better to me than, like a Rigetti and IONQ or, something like that that's got, a whole lot more potential downside to it. So I owned it. I bought the dip in it yesterday. I know it was up like 10% pre-market. I have no idea what it is now. We've been busy with a new launch, but I think certainly you want to keep playing that Trump trade. I think in what you've seen kind of in rare earth and some of that other stuff is you get a pop that then fades. So
that's what I was thinking.
As much as you can, you want to be a trader. But I do think these themes are enduring. I think you want to have some long-term quantum exposure. I think you want to have some long-term rare earth exposure. And then if you're a trader, you play the Trump pop and maybe, wind it down a little bit, take some profits.
All right. So I'm going to introduce our guest. We got Dr. Richard Peterson from MarketPsych. Talks a lot about some really cool stuff. Basically, he talks about large language models, et cetera, et cetera. Sir, why don't you tell us what you're doing and how are you today?
Sure, I'm doing well. Thanks for having me. So we do market psychology. So we're looking at perceptions of asset prices, things like, are we in a bubble? Or what are people saying about it? And then we look historically too. So we have data, for example, on news and social media back to 1998. And so we can say, okay, when people thought we were in a bubble for the housing market back in 2005, or when we thought we were in a bubble with the dot-com era, when did that happen? And then how do we know when that bubble topped? So we tend to look at data from that perspective of, what's the market psychology? What are investors thinking? And then how can we use that historically to predict the future?
That brings up a great question. How do you use that to predict the future? So, I'm an ETF guy, and you had a couple of ETFs come out that said, hey, we're going to follow social media buzz. If everyone's talking about Apple, we're going to buy Apple.
Right.
Yeah, it didn't really work. Yeah, I mean, some people I guess would claim, well, but when all the garbage stock or all the meme stocks, let's say, are going up, anything meme is going to be going up. I would argue it didn't really add a lot of alpha. What do you think about that? I mean, how do you use that data?
Yeah, it's a great question. So there's two fundamental patterns that are internally appear contradictory, which is why markets can seem so complicated. One of them is this idea of overreaction. So markets will go up a lot, like we were talking about with AI stocks recently and quantum stocks, and then they'll whipsaw and then they'll drop, and then, as you said, it looks like topping action because you've got things topping, going up, going down dramatically. This kind of volatility looks like topping. So that's called overreaction, where they go up and then they go down, and they didn't have a lot behind them, or the expectations of quantum encryption breaking Bitcoin and being a useful application. That's really 5 years out. So in the next 5 years, people are going to get pretty bored with these quantum stocks and move their capital elsewhere, and the prices will eventually sag again. So that's overreaction. But on the other hand, we have information that's not so dramatic, that's not so eye-catching as something like quantum or AI. Like companies' earnings come out and they're little by little getting better and better, maybe in liquid cooling companies or data center electrician companies that are rolled up by private equity. You've got these companies with nice earnings growth little by little, but they're kind of boring and routine and no one's really paying attention. Those companies do tend to outperform when they have good news, and that's called underreaction. So they have good news again and again and again, but it's kind of boring and routine, under the radar, and those companies outperform. So on the one hand, when we look across, say, thousands of companies in the US, the Russell 3000, when we look at their overall news and social media sentiment for the last month or even the last year, the companies that are the most positive tend to outperform quite significantly those that are more negative. So there's this nice spread over thousands of companies. But when you take only the top, say, 50 companies that are the most talked about, most loved in the market, you get the opposite effect. So the ones that are the most loved tend to underperform because they're likely, they shot up, everybody loves D-Wave systems, and now it's going to fall. So you get these two internally contradictory types of patterns. We tend to pay, most people, and probably your show, we pay attention to the ones that are in the news, the things that are really popping. But those tend to be the ones that mean revert. Whereas the fundamental pattern, like if you look at the NASDAQ the last few days, it's been pretty solid. But as you pointed out, the AI and the quantum stocks have really been suffering. So there's this internal contradiction in markets that's really interesting.
Okay, so then basically if I see lots and lots of people on social media talking about, say, D-Wave, that's not necessarily something where I would look at it and be like, all right, that's a signal for me to get in. What you're saying, and correct me if I'm wrong, is it's more likely that's a signal that this thing went up 500%, and it's probably going to mean revert instead of go up another 500%.
Yeah, well, the real challenge and where this gets confusing is, when does it transition from that kind of boring routine news, like, oh, D-Wave's adding customers, D-Wave's getting more earnings. Oh, look at this. Yeah, I saw recently, like, their earnings are up to $3 million annually. Like, I mean, given their $1 billion valuation, that doesn't matter, right? But at some point, they transitioned from a routine. People were paying attention to D-Wave 20 years or 15 years ago. People were excited. So they've had multiple cycles. But at some point, it transitioned from this boring routine underreaction to people just going in a frenzy. And the frenzies can go for a while too, right? Like John Maynard Keynes says, like, you can go bankrupt trying to, I forget the saying exactly, but you run out of liquidity, right? When you try to bet against something like that. So it can go for a while. And so then you look for this topping action that you were describing. There's certain characteristics. One that we see is people only talking about price action, no longer talking about fundamentals. So once they're talking about, like, oh, look, to the moon today, or oh no, it dropped, buy the dip. When it's all day traders, that's when you're at a top. And it could still double, it could still triple, but you know that in 4 years, 3 years, you're going to be at a lower valuation.
So, all right, that's
and we're checking that box now, right?
I mean, yeah, I look at the social media, it is largely about, like, hey, it's going to be another 10 bagger from here. And, that's not really sustainable.
Sorry,
That's
Mark.
not what you want to see. You want to see people saying like, oh, they've got another, batch of orders for $1 billion from Dubai. That's
Right.
what you want to see see something sustainable from a
So
So the
you're not
psychological perspective.
just watching the chatter, you're watching what they're talking about. It sounds like that's more important.
right, adds a
Exactly. Exactly.
language model.
Yeah.
Yeah,
And
So
so
it's
we're
like
looking at like accounting. What's the sentiment about the accounting at the company? What's the volume of references to the accounting versus what's the volume of references to the share price? And people just speculating. And what's the amount of optimism? Are they talking about the share price with a lot of optimism? Are they bullish, really bullish? That's not really relevant to, oh, that tells you that we're hitting a top. But again, it can still double or triple from here before you get, but you do know, again, in a year or two, it's not going to be up here. It's going to be lower.
yeah, I mean, yeah, no one's figured out the 100% accurate market timer. I think, what people like you are trying to do is just give people tools to potentially improve their trading.
Yeah, and actually, the one thing that we do see that's pretty interesting is when you get a liquidity shock. So when it's been going up a lot, and you get one of these come to Jesus moments, like we had 2 weeks ago when Trump announced the higher tariffs on China, and then all the speculative stocks dropped, 10, 15%, and everybody who was over leveraged was like, oh my God, I could lose a lot of
Right.
money here. Maybe I should trim back a little bit, and then they got a breather. It goes up again, and then they're holding on, and they're thinking, maybe I should trim back a little bit just to be safe. And that's usually when you get a top. We saw that in the dot-com bubble. We saw that a little bit with the housing crisis when the bond market froze up in '07. So you see these moments of liquidity shocks where everybody who's over leveraged starts to realize they're naked and the tide's going out. And that's when
So
things start to wrap up.
this is a good example because we talked about that on our podcast a couple of weeks ago whenever it was happening. And Matt was saying, yeah, I read all this stuff where guys said they just lost their whole life savings overnight and all that. What do you make of that how do you fit that in your model? I mean, that's obviously a big point, no?
Yeah, that's a great point. We actually don't know how to pick that up yet. Oh, that's a great. We are not doing that. That's something I need to add.
um,
That's a good idea.
Told you,
Yeah, like
Jay.
we have a
does it
liquidity
utilize
thing, but no, not like that.
Nah,
does it
right.
utilize comparative analysis with price action? Like, as
Yeah,
a day
that's
trader,
pretty.
we can see
That's
where
where it
all the
gets
limit
really
orders
good.
are.
Oh, interesting. No, we don't look at the order book ourselves. We just look at price action. But when we look at, say, so when people are saying, like they're fearful, when people are panicking and the market's dropping a lot together,
Right.
that's usually a sign it's actually about to bounce back. But when the price is dropping and everyone's still optimistic, like, oh, it's going to recover, buy the dip, then it'll keep dropping until they get scared and start saying,
Right.
man, I'm out of here. Forget it. I'm done.
Yeah.
It's capitulation. So we've spent a lot of time measuring capitulation and overexcitement, but we haven't done any measurement on that liquidity crunch that I talked about.
Right. Yeah. So
Do
you're
you
with
do
the
any
oh,
measurement on like option trades and things like that?
We're looking at what people say, but we haven't actually crunched that data yet because
Okay.
it's, 0-day options, all that's pretty new, and we're
Well,
we're going
it's
back for
not.
many
Yeah,
years.
I mean, I would assume there's some interesting data in that. What I also would assume is there's some interesting data in like unusual trades. But
Yeah,
that may not be your purview. I mean, unusual trades are trades where it's obvious someone knows something. So you get a company that hardly trades options at all, and all of a sudden, $1 million worth traded for it to go up 10% in 3 days. Like, wait, what,
yeah.
what was that? But I think you could also get an idea, what the big institutions are
excuse me.
doing, and look at shorter term and medium term options. I don't know. I mean, maybe there's some use in that. Not sure. Just throwing it out there.
It's always the expected move.
So you're with the LESG, right? How does that help, or what do you guys do with? How do you do that? I see that all over your stuff. So how is that? I used to live in London, by the way. I've been to LESG.
Yeah, yeah, it's a great place. Well, we're a separate company. We use them as our sales and distribution channel. So they do all of our sales and distribution for our major data products.
That's a pretty good rubber stamp,
Yeah.
though. Yeah, it's got to be. Could be worse.
Yeah, it's great. Yeah, we do some other stuff too, like Yahoo Finance. We do the named entity recognition behind their news pages. So if you see a company that's misattributed, tell me because that's on our side. We also do the iPhone stocks app. We do the natural language processing that identifies the companies that are linked to market data there. So
Oh,
we
right.
scan all the news articles and then link up those company names. We're the
Right.
software behind that. So we do a few other things, but yeah, primarily selling data feeds through London Stock Exchange.
Got it. So we do the Heat podcast. This is what we are. We also have that Heat newsletter. Subscribe to that one, guys. But so you talk about themes, like T for Heat is themes. So you identify themes, right? That's one of your big things, right?
Yeah, yeah, yeah. It's interesting. There's different types of themes, of course. We have a new data set that we're still working on. It's still under wraps, but we identify trending themes like Labubu, as it comes out into the media, and then we look. What we do though with the AI is we identify all the companies associated with that theme, and then look at the sentiment about them. So Trump announces a new tariff on Switzerland, and our software will pop out. Okay, look, Rolex is negatively correlated with these tariffs, or has negative sentiment. So the price, should be hit. But also, did you know Lockheed is negatively associated because if he does these tariffs, Switzerland will cancel their Lockheed order. That's going to be bad for Lockheed. So it pulls out these interesting, things. Or Mercator Bank. Did you know that they're actually going to benefit from Swiss tariffs? And so our software is able to dig through all the media because we're capturing thousands of social media sites and news sites in real time in the business world. And we're getting all of that content in 28 languages. And then we're pulling apart what everyone's saying about every asset in real time. So that our goal is really to have this financial information engine that captures everything, quantifies it, and then sells it as data feeds or as other products for people in the
Right.
markets.
So if I showed up, go ahead.
What's that?
Go ahead. I was just going to ask, like, is it if I looked at it today, like now it's what 8:30 out here. If I looked at it at 8:30 or whatever, and I looked at it at 9, would the data change?
Yeah, I mean, it's a minute. We have a minutely feed, so it'll.
Okay.
Yeah, we usually average it though because it's pretty noisy. Like you get people arguing in one place, and it'll like go dramatically higher as everyone's bullish,
Right.
and then somebody will argue against them, and it'll go lower. So we average it out, and then you can see interesting patterns when you average it.
Right.
Oh yeah.
You can see like obviously the business cycles you can see pretty clearly, but
Right.
you also see the broad just moving average crossovers of sentiment tend to lead the moving average crossovers of price. So when sentiment drops, especially when sentiment's high and sentiment drops, people don't react in the price right away. So the sentiment will drop, and then it's sort of a gravitational pull. Eventually, the price will drop. But you see that a lot. You saw that with COVID. COVID hits, it's really bad. Prices stayed high for a long time. And you remember the financial crisis, like Chunk Prince said, we keep dancing until the music stops. Everyone kept
Right.
dancing for a while, even though the sentiment was plummeting. So eventually
Right.
it'll pull down the price, but you got a few weeks, sometimes a month or two. And we've had
Right.
clients who talk about using that as a risk-off signal. When sentiment's high and it drops, then the price follows. So there's a few
Right.
patterns like that that are pretty interesting. And you can feel that now, like sentiment has clearly dropped. Like we were looking at our company meetings today, references to financial bubbles are at a multi-year high right now. But they've been pretty high since June. So it's been a while. People said we were in a bubble, but there's still a lot of great bubbly action that occurred. Now it seems like the sentiment's really going negative on that though. So
Yeah, it's definitely negative for the market then, because sentiment was high, it's now dropping.
I mean, it's negative in the short term, but the bigger macro picture is very positive.
Okay.
There's just a lot of money coming to the economy, a lot of spending.
Now, are
So
you measuring the macro picture, or you're just looking at what everyone else is looking at?
no, that was me just pulling that out.
Okay.
That's not from our data. Yeah.
Right. Yeah. Yeah.
So it's
So-
kind of like Matt and I. It has a knack for being able to pick up on things that are underviewed by Wall Street in general.
Yeah,
And,
it's a great point. Like it's
attach it
often
to
those,
themes,
it's the things that people aren't paying attention to that often have some of the most value.
right?
Right. Yeah, I agree with that. Like a Ouija board. I always use that
I
analogy.
mean, I
Yeah.
have to
Yeah.
say we were pretty good at that for a long time. So,
Right. Yeah. So let me ask you another question, Richard, sir. So
Mhm.
You talked about tariffs a lot this year. Obviously, that sentiment swung all over the place. So it's obviously a great topic. I mean, you can talk about it all day, I guess. But like, you mentioned something here in one of your posts about like CNBC said this was good. True Social said it was bad, or So how do you discriminate between like? There seems very little middle ground. It's either the worst or the best. How do you figure that out?
Yeah, it's a great point. I mean, so we were talking earlier about how we talked about options. There's all these different ways of measuring sentiment. So
Right.
there's a lot of ways to get into the weeds. And so we as a company decided let's pull back and look for the fundamental ground truth of markets. Like how does information move prices? So we're trying to quantify information. And so information has topics and it has tones. Like are people positive about the tariffs for the economy or are they negative? And when you start to combine the topics and the tones, you create what's called a narrative or a story. And ultimately, it's the stories that drive markets. So with something like, so big picture, we're trying to find what are these broad patterns. And there are these
Right.
broad underreaction and then these broad overreaction patterns, which I described a bit. Tariffs is sort of it's an old story um, and a new story recently, but it also fits into the old patterns. And so what we saw that was interesting in the spring, so we did a study, maybe you're referring to that, where we looked at earnings conference call transcripts, and we analyzed the companies that talked about tariffs or the ones that didn't talk about tariffs, and how much did they talk about tariffs in their transcript. In March of that year, companies that talked about tariffs more than 30 times, their share prices dropped about 6% over the next 2 months, through April and May, and end of May. But the companies that didn't talk about it at all, they were up 12% over that period, and the ones that talked somewhere between 0 and 30 were, I think, down about 4% or 3%. So talking about tariffs was generally bad. If you didn't talk about tariffs at all, which was thousands of companies didn't mention them in March, your share price was up 12%. So what really drove markets this spring was entirely the trade war. Like, you can completely discriminate performance based on which companies were affected by tariffs or not. So there's different narratives. It was tariffs in the spring. Yeah, the tariffs will be coming back. It's still happening. We saw Rosneft was just hit with sanctions recently, but they're not traded here. But still, there's London properties for Lukoil and Rosneft. So there's things that will matter. As I said with the Swiss tariffs, there's things that are happening still. And there's other narratives. Now there's this bubble narrative. But like I said, fundamentally the Nasdaq, is still pretty strong macroeconomically. There's still a lot going on. So, is this the kind of bubble that's going to sink the whole market, or are we talking about AI and quantum bubbles just being interesting trading opportunities that aren't, like the dot-com that didn't actually sink the whole market?
Right. Got it.
Anyway, a lot of things to pull apart there, but big picture, we're looking for macro
You
trends.
mentioned something about earnings transcripts. Do you guys do anything with voice where you're analyzing like tone, tempo, inflection?
That'd be cool.
Yeah, we don't do it from the audio. We actually do it from the text transcript.
Okay.
And there's a
Oh,
couple of
really?
reasons. Yeah, there's a couple of reasons for that. One is some people naturally sound stressed out when they talk. And
Right.
so then you have to create an audio database of that CEO. And then they might be stressed out because they're hiding good news and they're not allowed to say it, or they're stressed out because they're hiding bad news.
Okay.
Or it might be, so it could be good stress or bad stress, and it sounds the same in the voice. And
All right.
or they could just be irritated with an analyst, that's on the call, or maybe something they didn't sleep well the night before. There's all sorts of things that affect voice. So we actually do it from the text, and I mean, we get pretty cool results. One of our results is so CEOs, if you just look at their speech, the text of their speech in these earnings conference calls, the overall sentiment of a CEO does not predict their share price. But if you look at the optimism in that text, so how much future-oriented positivity, that significantly impacts their share price over the next 3 months. So you get like a nice 3 month
Have
drift.
you had any good ones of those recently? Like any standouts? Like, oh, this guy was the greatest we've ever had?
That's it. Yeah, I could look right now, but yeah, we have a tool that's running in real time, but yeah, it would take me about a minute to get in there.
All
Have,
right. Okay. So
But
they,
I
okay.
didn't check it myself. Yeah.
Okay.
have
But
you
they're out
gotten
there.
any sense that companies are getting wise to this? And I ask because
Yeah.
interestingly, I had dinner last night with a quant, and we were talking about some of this. He said, everyone now is looking at, these transcripts with AI, and companies are getting wise to it and realizing, hey, we want to say this, we want to say this, we want to say this, because the AI is going to pick that up.
Yeah.
Are you seeing any of that? And have you figured out a way to kind of filter that?
It's a good question. We have seen a reduction in the alpha from the typical patterns in the transcripts in the last couple of years. But there's other patterns that they're not aware of, and ones that's probably better for I don't talk about because they're kind of interesting.
Totally.
So
You don't want to put that out there and see your alpha go down even more.
Right.
yeah, so there's definitely these, but the things like the tone. Also, there's things like analyst. This is public too. So analyst disapproval. So an analyst comes out and is arguing against the company on a call. We have this emotional tone called disapproval. And when the CEO argues back and is irritated, that's actually a bad sign for the company's future. So when you get these combative situations on calls, that's actually usually a bad sign because, why is a CEO getting tangled up with an analyst who probably doesn't know as much as they do about this? So there's some interesting questions that come out of this, but yeah, disapproval on calls or kind of, conflict tend to be pretty bad sign too.
What I've found, which is interesting, and I don't know whether there's anything there or you could do anything with it. So when, social media sentiment, that whole idea first came out, I was looking at it from, hey, people are talking about XYZ, and I didn't find any real correlation there. And I think probably, found what you found. By the time everybody's talking about something, it's tough. What I ended up doing is finding who in my mind were the smartest people on Twitter, following them, but then most of them had discords and getting on those discords. And what I find with that is they're often ahead on, on themes, on hedging, on a lot of different things. So, I'm still doing my sentiment analysis, but I'm just saying, hey, I just want the sentiment of the smartest guys out there.
Yeah, I think it's a good idea. We had a client who ran a portfolio on that for several years, but they made, I think, about it. So it was a big pension fund. They did what was called like the top performing authors. So we had like hundreds of millions of people, posting on various news and social media sites. And they would track the 1% that had the best forecasting accuracy. And they built a portfolio around that. But it was a big portfolio. It was like, 1,000 stocks or something. And so it was probably too big. But anyway, they got like 100 basis points outperformance annually, maybe 150. But it wasn't enough to justify for them to set up a whole new investment product. Right. And then the lead quant left the firm anyway after 2 years. So, but they did show it for a couple of years and then shut it down. So there is some value there, but it's, again, a lot of the value in this stuff isn't dramatic. It's a couple % a year after transaction costs. So it's something, and I'd take 2% a year extra, but it's not, it's a lot of work to find it. And so it's like, to your point, you can look at it, you don't see the immediate correlations. You really have to dive deep, and then you're at risk of overfitting. So you got to you got to understand the principles behind it and really believe in these core principles and make sure academics have verified it historically and other people have shown this, and then maybe there's some value to it.
So I'm going to switch up here for a second. Oh, go ahead, Jay.
I was going to say, yeah, it can be a lot of work doing that, on your own, trying to cross-reference a bunch of information and then find the gems. And in my world, comparing it to price action has been key, but it doesn't always work out that way when it comes to market sentiment, because you got a lot of people chasing that same alpha that you are, and it affects the way the price action moves anyway. You can see the reactions right on the chart and the way things just change suddenly.
You can actually, speaking of that, like I mentioned at the tops, so broadly speaking, when you have like the S&Ps at a top and then the sentiment starts to dip and then the price a month later will start to dip, or a few weeks later, we at the bottoms, what we see is the price rises first. The sentiment is really low, the price rises first, and then people kind of correct themselves. And there's some academic research that shows that people are afraid financially and you remove the fear stimulus, they'll take more risk than is rational. So, for example, it's like a relief rally. People are so relieved by the fact that the market is going up again, they'll just put it all in and put all my chips on the table. And they'll take
Right.
far more risk than they would have otherwise. And that really powers the rally further and then raises sentiment further. So on the top side, sentiment falls first, but on the bottom side, the price rises first. And that's also a confusing use of this data for a lot of people. They don't,
So I
you
think
don't,
this
you don't
leads to
expect
what I
that.
was going to ask, Richard,
Yeah.
right? So you talk about investor identity, right?
Oh, yeah. Yeah.
So, which I think is a real thing. Like, you have to trade with what you're good with. Maybe that's not what you're saying. You feel comfortable with. What do you make of investor identity? And how do you would you develop an investor identity? Like if you're a young kid like my son, he wants to do this, wants to do that. I'm like, how would he identify an investor identity?
Yeah, that's a great question. And that's a really big question. So I'll kind of touch on it, but
Yeah.
I'll miss the mark for a lot of people, but I'll do the best I can.
All right, sure.
So the big picture is as an investor, you have to think about, number one, what am I good at? What are my strengths in the market? Am I disciplined? Am I open to exploring new ideas? Am I willing to put in the hours? And then what am I bad at? And you got to be really honest with yourself. And this is the hardest part. Do I hold my losers too long? Do I second guess myself? Do I turn
Right.
a long-term position into a short-term position and start trading it because I want to action? There's a lot of mistakes that people can make. And so as an investor identity, you've got to do an honest assessment. What are my strengths? What are my weaknesses? And then what area of the market is most interesting to me? What gets me excited in the morning? Zero-day options. I think there's a lot of opportunity there. Or
Right.
am I excited by long-term technological developments like quantum? And what's next? Who's in the supply chain for quantum? I really want to deeply research that. I do coaching with hedge fund managers that I used to do quite a bit. I don't do much anymore, but I did. I had one guy that was really interesting. He could only short stocks.
Right.
And he loved finding CEOs who were just full of garbage. Anybody who was just
Right.
lying, he wanted to find those bastards and he wanted to out them.
Right.
So he would,
I
but
like
he,
that.
when the markets were rallying, like lately, he's not a hero. Like everyone's
Right.
like, come on, man, buy some stocks,
Right.
you're just treading water here. And he's like, no,
Right.
these guys are lying. I know they're lying. And every time there'd be a financial
Right.
crisis, he'd make 80-90% on his portfolio.
Right.
But in the meantime, he's just losing a little every year and people are getting really
Drawdown.
frustrated. Yeah. So him, he had to be like, well, should I be buying stocks? And it was like, well, what do you love? What are you good at? No, you're good at this
Right.
one thing. Don't deviate from what you're good at.
That
And
leads to
what
my
you
next
love.
question. This will be a good question to add on. So
Hope
when
so.
things go wrong, what mental processes usually break down first?
Yeah, that's great. That's a great question. Well, usually things start going wrong because we start to undermine ourselves. We didn't get a good enough sleep the night before. We had an argument with our spouse or our kids or whatever.
Right.
We get a little unstable in our cognitive load. Maybe, it's like time to file taxes and you got to get all your paperwork together. So your cognitive load is a little too high. And then you look at the markets and you're like, I don't know what's happening. God damn, and then you change something that you shouldn't have changed. And that kicks off a
Right.
cascade of
Right.
bad decisions.
Exactly. I
You know?
call it like it's like the sand trap syndrome. You just got to hit out of the trap and go on to the next spot, but you keep slamming it into the trap over and over and over. All right.
Yeah,
I
exactly.
get that one. Yeah.
So, and
Kinda
the key
been
there
me.
is to try to always be like, where am I today? Well, first of all, the key to that is to prevent these issues, to try to create a stable, consistent lifestyle, which most traders have trouble with because we like stimulation and excitement.
Right. I have
So
this
it's
conversation too with people. It's fine. Yeah.
Yeah.
All right. Next question. So, what asset classes respond the most to sentiment? Can you say that?
Yeah, that's a great question. I mean, it does migrate a bit. Obviously, precious metals lately, there's a lot happening with sentiment.
Right.
In the stock market, it's usually financials, technology, of course, a little bit on industrials, but then the other sectors less so. Now, lately, of course, utilities also.
Right.
It migrates a bit, but it's really what you would expect. It's the companies that don't have a lot of revenue but have a lot of promise, or there's a lot of excitement. So we look at, the last 2 years, robotics have been the most exciting sector, and then AI is shortly after that. So we look at
Right.
different industries and we rank them by how much optimism there is. And robotics has been the highest for the last couple of years. And so I think Yeah, there's a lot of excitement there, but it doesn't mean it can't even get higher with robotics. Robotics has been, most people don't know what to do beyond Tesla and Optimus, but there's a
Right.
lot of other things happening in robotics right now. So
Do you like take derivatives or take the rate of change and the, I don't know how to say it, but do you take
yeah.
you said something before about the, you answer the question without me sounding like a moron,
Oh, sure.
please.
No, yeah,
I already do.
we we do look at that. Yeah. We've built so long ago. So we had a hedge fund. We had the first social media based quant fund from
Right.
2008 to 2010. And
Right.
back then, the best trading signals we found were rule-based signals, where it would look at the rate of change, a spike in attention on a given company, plus a big jump in the price or a big drop in the price.
Right.
And it then depended on, what. So often, if it was a jump in the price and a lot of attention spiked up on the price, it would go for another day or so. There'd be a little bit of momentum, and then it
Right.
would roll over. And there was kind of a nice predictable pattern, almost a weekly pattern of, it jumps for a week and then it drops for a week.
Right. Got
And
it.
that,
Does it also look for consolidation points between different impulse moves?
so the challenge with the statistical methods that we use as quants is we can't get to that level of granularity without overfitting. We just don't have the data. But the human brain, you can look at a chart and you could do a great job of identifying a complex pattern and sort of distilling it down into the real point. I've talked to
Right.
people now who are using LLMs for image recognition, and they claim that they're getting great results where they'll feed in stock charts and thousands and thousands of stock charts and train an LLM model, and then they'll say, "Okay, here's today's action in gold. What do you think?" And it'll give them a result, and those results are actually pretty good. So there are some new applications of this like deep neural network technology, LLM technology, towards image recognition, but historically the human brain has been the best at that.
Right.
It's
But
been
where we're
my
not
most
the best
success.
is we trip ourselves up, and you just see that time and again if you're a technical analyst. You'll like, oh, I'm on fire, and then suddenly you just start making a series of bad decisions and it unravels.
It
So
happens.
that's the
One of
problem.
my
Yeah.
favorite sayings, and I don't know whether I made it up or I heard it somewhere, is when you're starting to pat yourself on the back, take profit.
Right.
Yeah,
Yeah,
exactly.
absolutely.
Yeah.
Oh.
You can't be right all the time.
All right. So
I mean,
what's something you
but
believe in? Oh,
I've heard
sorry.
other stories. I mean, I even have one personally where my company was big into Bitcoin early on, and I sold my Bitcoin in 2013 because I was like, wow, I made so much money on Bitcoin. So, you can miss
Right.
the other 100x return. And that
Right.
one time, for me, balance out every other time that I did sell when I made a, 10x or 5x
Right.
return on something. So you, the people I've known who've got really, really wealthy often were the ones who bought something and held it through all the ups and downs, like Bitcoin or real estate, things like that.
I
Yeah.
mean, going
So,
back in higher is like the hardest thing to do for anyone, I would guess, right? It must be. All right. So, like, next question. What's something you believe about market or investor behavior that you no longer believe?
oh, that's interesting.
Thank you. I try.
Well, it's interesting because I was talking to a couple of our quants 2 days ago, and I was saying, what do you guys think about, our sentiment data? What do you really believe is truly predictive in this? And the range of responses was fascinating. Some people were very confident in one or two findings. Some of them one was confident in none of the findings. He's just extremely skeptical about everything after
Right.
5 years of working on it,
Right.
Um, even though some of his studies have been replicated, from 5 years ago. It was really interesting. And people were, so I think the thing that I used to think there were simple answers in market psychology, but the answers aren't simple.
Right.
There are good answers, but they require a lot of work, a lot of months of research and setting up systems to take advantage of them.
So
So I
it's
used to think it was a lot simpler than it is. It's
so
really
it's harder to
complex.
identify. That's what you learned. Mm.
Yeah,
So one
it's
more.
not
This is
simple.
my last one. It's kind of
Mhm.
related. If you had pick one misconception about investor psychology that you'd like to permanently destroy on the Heat podcast, what would that be?
Misconception. That's a good one. I feel like the short-term trading is usually not the best way to go for most people.
Right.
It's fun and it's a kind of a good diversion, but remember that for most people it is just a diversion. There are a few people if you get in, but the thing where it is valuable is when you get into something new that other people aren't into, pre-institutions. So like Sam Bankman-Fried getting into, crypto arbitrage before the institutions did, or there's a lot of opportunity out there, but it's usually not where people are looking. So I would say if you're trading everything that everyone else is trading, you're probably missing the boat on something else that's quite interesting.
Good point.
And how does the sentiment lead you to that something else? Because it would seem like the sentiment's going to lead you to what everybody else is trading. How do you find what everyone else is missing?
So the sentiment, I guess, like I said, the sentiment will make you a few extra percent a year. But where you make the bigger money is looking at where there is no sentiment, where there's something new that's happening and nobody's talking about it yet. And you realize, oh, I'm one of the first people on this. And this is going to be a lot bigger than people realize. So you just get in early and then hold on. That's generally what I've seen in the past.
That's interesting because that goes along the line of a lot of what we teach in kind of thematics, where part of it is you've got to be in the hot themes. I mean, we all know AI, robotics, drones, space, power, all
Right.
of that stuff. But then it's also being able, and so what we do is I'll read all the major financial publications every day looking for just that nugget, like,
Right.
that's something I never thought about. And a lot of times I'll use AI on it, like, hey, what's going on here? Is this really a thing? Who are the winners? Who are the losers? Who are the suppliers to the winners? Who are the suppliers to the suppliers? And really drill down and try to find things before obviously if you're reading it in the news somebody is talking about it, but before like everybody is
Exactly.
talking about it. So yeah, I mean, I
Before
think
it gets trendy.
that's a great point.
Yeah, and sometimes they do get trendy, like Bitcoin. Like I said, 2013 seemed like everybody knew about Bitcoin, but there's also this bias you can have where something like generative AI or quantum really might change the world. And, it's just that it's overvalued for now, given that it's going to take another couple of years to, before they're going to have a little trough of disillusionment before it takes off again. But it doesn't mean you should decide, am I a long-term investor here? Am I going to hold through the 90% drop or the 80% drop? Or am I just going to try to trade through this? And what usually happens if you try to trade through it, there's another interesting psychological effect called the repurchase effect, where it'll drop and you'll think, oh, I'm a hero. I sold out my quantum stocks. Quantum is not going to be big for a long time. Quantum goes under the radar for a couple of years and then it takes off, but you didn't notice it because no one was really paying attention.
Right.
And then you look at it and you're like, oh my
Right.
God, it's almost at my purchase price. Oh, wait, it's over my purchase price. And once it's over your original price, there's something called the repurchase effect, which is really interesting, where fund managers and most of us won't buy something if it's already above the price where we sold it because we were just waiting for it to dip again. And it'll just keep going and going and going.
It's the
And
worst.
but if it's below the price, and especially if it's going down, we often do buy it. And that's actually a bad sign. There's
Exactly.
studies on portfolio managers. They have like a 17% gap in performance. I think it was, yeah, it's a huge dramatic difference. The stocks that go up above where you bought them or sold them previously, you really should jump back in on that train. And the ones that drop, that's a bad sign. You probably shouldn't buy them back. They're not cheap. There's a reason they're low.
Right.
Takes
So
it right back to that statement. The market can remain irrational much longer than you can remain liquid.
that's the one. Yeah. Yeah.
Yeah, right. I got another question for you. This is a fresh one. So you talked about Bitcoin and sentiment, right? So Bitcoin was, out there for however long, since 2010 or whatever, 2020-ish, or shortly thereafter, before IBIT comes out, right? Kind of changes the game, right? So are those, for you or your models or just in general, I mean, are those two different things? Because it strikes me that Bitcoin went as far as it could go before it turned into IBIT and became institutionalized or whatever. Then it took a whole new, I think, the whole new life.
Yeah, I mean, I'm mixing the modeling we've done with my own opinions here, just like
Yeah,
I
that's
did.
cool. Please, I'm
for the
asking for your
macros.
opinion, maybe too.
Yeah, uh, so on Bitcoin, again, this is not a modeling issue because Bitcoin's hard to model because it mostly just goes up, but
Right,
it's hard to look for short opportunities on Bitcoin.
right.
Um, well, so what we're so what to think about it, when the futures came in, you suddenly had the ability to borrow and short Bitcoin, and once you add the ability to short Bitcoin or manufacture additional Bitcoin because you can go long it with futures as well, you've almost defeated the purpose of Bitcoin scarcity. Because
I
even if
guess that,
Bitcoin is
yeah.
scarce, you've got all these synthetic products that allow you
Right.
to leverage it in both directions. Um, so now Bitcoin's going to be largely dominated by futures trading or by this kind of leveraged betting. And there might still be that fundamental trend that pushes it up, but you've got a lot of other issues going on now, especially with all the leverage out there.
Right.
So with IBIT, I mean, there is some leverage implied in that because they're going to hedge at times, and there's going to be some, immediate when people invest into IBIT. I don't know if it immediately goes into Bitcoin or if they're using futures like some of the other ETFs, but
Yeah,
it certainly changes the
it will
dynamics.
immediately go into Bitcoin.
Oh, does it? Oh, good.
Can
Okay.
you repeat that, Matt?
It goes immediately into Bitcoin, and they've
I see.
changed the create redeem mechanism. I don't know whether it's effective yet. Where it used to be they'd get creates and redeems in cash. Now they're just getting it in actual Bitcoin. And just throwing it out there, I think IBIT's a game changer because
Mhm.
it allows people like me and Pat who maybe would not have traded direct Bitcoin to trade it, and it allows financial advisors access to it, which I think is going to be huge.
Right.
Yeah. Yeah. No, it should be, and everyone does need digital assets, I believe. I mean, even gold now, most people aren't buying physical gold; they're buying, digital gold essentially with
Right,
ETFs. So,
GLD or
yeah.
Right.
bags. Our fund.
I was going to
More
mention
people
that.
are buying GLD than they're buying bags.
Right.
Yeah.
So, anyone else, man? Matt, Jay, Richard, got anything to say? What's your favorite song, man?
Yeah, I mean, it's fun. The markets are tricky, right? So, I mean, I would just say it's a hard game to play, and when you look at who really does well for the long term, it is those people who find what no one else is looking at,
Right.
and have the discipline and the time to do that, and can withstand the gut wrenching declines and be patient on the upside too. Sometimes you don't want to sell out too early because things can keep going. So, but there's a lot of nuance to it. You got to know yourself and know where your particular weaknesses are before
Right.
you try to play this game.
So essentially, be like Matt and I, able to identify the underdogs in time.
Right.
Yeah. And have a
So,
business around it. Like I know, Matt's business is going to be is a successful business in part because of the long-term nature and the way you've sort of contained that. So a lot of the value you're creating is going to be in that core business, not necessarily in each individual pick.
Yeah.
Right.
So
right.
the machine itself is valuable.
Right.
Yes.
Yeah. Okay. So, it's market, MarketPsych.com, right?
Yeah,
MarketPsych.com. That's where you're at.
exactly.
That's the best spot, yeah?
Yeah, it's the best spot. I mean, we don't have retail trader tools. It's for institutions, but we do have great tools for institutions. We have pretty much anything you need to understand or analyze text, all the world's information flow around financial markets,
Right.
Very
data,
cool.
research tools, etc.
Got it. Okay.
All right, awesome. Thanks,
Thank
guys.
you, guys.
Remember,
See you later.
Thanks,
Have a
guys.
good
like
day.
and
Thank you,
subscribe.
Richard. See you. Have a good day. Are you in the Stanford area, or is that just what I?
Oh, I'm in Central California. I'm in San Luis Obispo. Sounds
You're up
coastal.
there? Oh, I get
Yeah.
up there a lot. Yeah.
Oh,
Not
you
too
do?
far from there,
Oh,
actually.
yeah,
I live
Pat's
in
gonna
North
show me
LA
around.
County. I live in North
Oh,
LA
Been there a
County.
few times.
Yeah.
So we go up that way a lot. We go to that one of those beaches over there with the big rock in the middle of the water. What's it called? I don't know.
Morro
Guys,
Bay?
Morro Bay.
I gotta go.
All right.
Okay, thanks,
Thank
Matt.
you.
All right. See you
Right.
guys. Thank you. All right.
Thanks for
Later.
coming on. This has been a very enlightening conversation. Thanks for
All
coming
right.
on.
Later,
And
guys.
thanks for
Yeah,
joining
I
us
wish
on
I had
Meeting,
some.
so.
Oh, good. All right.
Oh, no, but more about, yeah, we go, there's a family. We go up in there. I love San Luis Obispo, SLO, whatever, that little town. It's all great.
Yeah,
Some of
it's
my
nice
favorite
living up
memories
there.
as a kid were from Morro Bay.
All
Oh,
right.
nice. Yeah,
Yeah.
that's a
My
great
dad and I
place.
used to
Yeah.
fish there.
Yeah, we go
Yeah,
up and look at
we-
the seal. We go look at the seals and all that stuff up there. You know, we love all that.
Yeah.
All right.
Yeah, it's a great place. Yeah, I
All
go
right.
swimming out
See you
there.
later. Have a good
Take
night.
care, guys.
Bye.
Bye bye.